Welcome everyone to Module 2, Option Mechanics and Pricing. This is far more the meat and potatoes of option selling. I'm actually really excited to teach this because it's something I'm passionate about, and I'm hoping that it helps you and makes a difference in your life as you learn how to sell options and put your money to work so you can start actually believing that you can achieve financial freedom as opposed to just hoping for it. You can take some action and utilize some of these techniques. So what we're going to talk about today is specifically know what you're selling, price behavior, Greeks, and volatility. So all these things play into the way that options behave, how they are priced, and how you as an option seller can use volatility and time as an edge to create cash flow and income on your money. So here's the agenda. So again, we're going to talk about what impacts an option's price. We're going to talk about intrinsic value versus extrinsic value, time decay, also known as theta. That's one of the Greeks. We'll also talk about some of the other Greeks that are important in option selling, which is delta, and we're going to talk about that as a probability, why Vega and IV matter, or volatility matter. And then we're going to have an activity. We're going to actually go open an options chain. We're going to pick a trade using delta and IV. We're going to pick an expiration date, and we're going to look at premium collected, how many contracts, all that good stuff, just to give you an example of how this works in practice. So what impacts an options price? So an options price is influenced by the stock price itself, the strike price that you select that you're selling, the time to expiration on that contract, the volatility, the interest rates, and dividends. So these will affect how much buyers will pay and how much we can collect as sellers. Now, again, when you think about options and selling options, I really want you to think about you're basically an insurance agent now. You are selling stock insurance. So let's say someone out there in the broad stock market, let's say they own NVIDIA. And who knows when they got into NVIDIA, it doesn't really matter, but all we know is they want to protect their downside and they are willing to pay a good amount of premium to protect that downside. And if they want to ensure that they can get out of their stock, let's say, right now NVIDIA is trading right around, I think, 180-ish. So let's say that they want to ensure that they can get out of NVIDIA at 160. Let's say they can't lose more than that. They don't want to take on downside below 160. They will buy a put option from you, an option seller, who will sell them a put option at 160. And you will collect up front premium from them for that contract. Now, the best part about this is that you're choosing the strike price or the risk that you want to take on. You're also choosing the expiration date, whether it's a week, 2 weeks, a month, 45 days. We'll talk about some of the different time implications that play into options pricing, but that's essentially the idea of selling options. So let's talk about intrinsic value versus extrinsic value. So intrinsic value is where the stock is trading at right now, the value of the option if it were to be exercised by the option buyer. Now, that almost never happens. Early assignment rarely happens because of the time component and the value. Wherever that stock is trading, it has a lot of ability to move up or down, and whether or not they exercise it now versus a week from now, it may have more value to them towards the end of that options contract versus where it's trading at now. So early assignment is quite unlikely. Extrinsic value is time value and volatility. So it's where the stock could trade at, right? And where it could trade at in correlation with the amount of time that is in that options contract or when the expiration is. So in the money, at the money, out of the money. And we're going to look, a little bit later in our activity, we're going to look at what that means, what that looks like. But only in the money options have intrinsic value because, again, where the stock is trading at and below is where the value currently is because that's where the stock is trading. That's where buyers and sellers are trading it. Out of the money options are 100% extrinsic. So again, that's time and volatility. That's where the stock could be. And so the extrinsic value is less than intrinsic because it's where it's currently trading at, not a future value that it could be. So we prefer to sell options with high extrinsic value because we can collect that premium out of the money, give ourselves some downside protection, whether we're selling a put or we're selling a call, and collect a great income while possibly acquiring shares of a stock that we like at a price that we are willing to buy it at. Is the inverse. We own the shares and we are willing to sell them at a strike price that we choose, and we collect a premium up front while we wait for those shares to reach that price and be taken from us, called away, essentially, or assigned. So let's talk about theta. Theta is where kind of the magic happens in all this for being an option seller because theta is the time decay in our favor as sellers. So Theta measures how much an option loses value daily due to time passing. So this decay accelerates as expiration approaches, especially in the last 30 days. That's why generally most people, when they sell options, when they sell puts, they sell calls, they usually do a 45-day or less option because that time decay speeds up in their favor in those last 30 days. So if you're selling an option, let's say that has a negative 0.010 theta, you're essentially looking at an option that will decay $10 a day in value in your favor. So that's $10 a day that's being taken from the call buyer and given to you as the call seller as that option decays in your favor. Again, when you buy an option, the decay happens on the buy side because that option is losing value every day. That intrinsic value is being pulled out of the option. So theta decay is the profit for option sellers. So some of the other Greeks that we need to talk about in terms of option selling, they help us understand how options respond to market changes. So delta is essentially direction and probability. Theta is the time decay, like we talked about in the last slide. Vega is the volatility sensitivity, and gamma is the rate of delta change. So as sellers, we care most about theta, delta, and vega. Now, there are other Greeks, and they pertain more to option buying or even some more advanced option strategies if you are using multiple leg options. But for the sake of being a beginner intermediate, we're really only focused on selling options and the Greeks that matter most when selling options to stack the probabilities in our favor. So delta tells us how likely an option is to finish in the money. So if you remember on the previous slide, we talked about delta being probability and direction. So for example, a 30 delta put means there's a 30% chance it finishes in the money or has intrinsic value, and that you would be put or assign those shares. On the flip side, though, there's a 70% chance that you keep the premium and you also keep your cash collateral and you are not assigned the shares. So you can see here that that delta, that probability is stacked in your favor as a seller to where 70% of the time you're keeping the premium, you are not being assigned the shares because the stock price did not move down below the strike price that you are selling. So generally speaking, selling options with a 15 to 35 delta is a really good balance of risk and reward, and where most option sellers tend to choose their strikes to sell. So Vega and implied volatility. Vega shows how sensitive an option's price is to changes in implied volatility. So the higher IV is going to give you higher premium, which is good for sellers, but it's also inherently tied to the amount of risk that you are taking. Now, the risk being that you are assigned the shares at that strike price that you are selling. So if you are selling at the money or even in the money put options that are higher than where the stock is trading, there's a very good likelihood that you will be assigned those shares. And when that happens, you will be assigned at the strike price that you chose. Let's say it's trading for $44 a share and you decide for some reason to sell at $46 a share. So essentially what would happen is if the stock doesn't move above that $46 mark, and let's say it just stays flat and you get assigned at 45, you're now $1 per share down on that option that you sold because you will be assigned those shares at that $46 strike, even though it's trading for 45. So that is the risk. Now, if you're trading on stocks that you love, and that's rule number one, and you're choosing sensible strikes that are below where the stock is trading, giving yourself some downside protection, then that's a very good strategy. And that's why delta can help you quite a bit in choosing which strike that you are willing to sell based upon your risk tolerance. So again, lower IV is less premium and tighter ranges. And so you want to find the balance between medium range volatility. So again, just a quick follow-up on the Greek. So delta is probability and price movement. Theta is the daily value loss on the buy side if you're selling. Vega is the value from the IV changes. And gamma is the delta's acceleration. So remember that time and volatility are your edge as an option seller. That's where that premium is made and collected, is based upon the volatility, as the risk is tied more to speed of the price moves. All right, so we are going to find a high IV, low delta trade, and we're going to open up an options chain. We're going to look at a stock. We're going to look at what the IV looks like, the premiums that can be collected at those levels. We're going to analyze the delta. We're going to specifically note the strike price, the premium and the expiration date of the option we're selling. And we're going to estimate our profitability of profit and how much that profit is that we can collect. All right, so most brokerages are going to have an options chain that looks very similar to this. They're all slightly different, but they tend to have the same indicators for you to select put or the call at the strike that you're looking to sell or buy. So if we come over here and we take a look, we've got the bid and the ask, right? The bid is where is what the buyers want to buy the option for, and the ask is what the sellers want to get paid. Okay, so that's how you got to think about the bid and the ask. And there's always a spread here, right? You see this option right here, this strike at $45. The bid is 66 cents. The ask is 70 cents. There's about a 4-cent spread there, and that's a very good liquid tight bid-ask spread right there. So generally speaking, if you're selling, you're very rarely going to get that. I mean, I've never done it. You're most likely not going to get this higher amount that you're looking to sell the option for, but you can definitely negotiate that price to land in the middle of that spread and get the highest amount of premium. So looking at this, you could probably get a 68 cents per share. Most likely you'll get 67. As you can see here, this last column right there is showing that the last option that was sold was at the 67-cent mark. So again, closer to the bid side, right? Because that's what the buyers are willing to pay. So as we look at this, let's go through these different columns here and take a look. Now you'll notice there's a call side and a put side. This gray line here is where the stock is currently trading. Everything in white on the put side is out of the money. Everything in white on the call side is out of the money. So if we're selling a put, this is where we want to be, is right here, right? Because that gives us that better risk to reward ratio and gives us some downside protection. So as we look here, let's scroll over to where we can see the Greeks, because we need those. So first and foremost, let's look at the delta here. So as you can see here, the 45 strike is a 20 delta, meaning there's an 80% chance that the option will expire worthless. You will keep your premium and your cash collateral will be released and you can move on to the next trade. Now, if you look up here at the money, right, this delta right here at the 49 strike is a 45 delta. Generally speaking, at the money, you've got a 50-50 chance, right? So there is a 45% chance that you will be assigned these shares at $49 per share. But you will also notice at that level that your premium that you can collect is higher. $1.76 per share, which equals $176 per option contract, because each contract controls 100 shares. And if you look down where we were looking before at that 45 strike, you're looking at 66 cents. So as you can see, it's almost 3 times the amount of premium collected. But again, you're taking on more risk that you'll be assigned at this level. And the stock could, let's say, by Friday, which is what we're looking at here, January 9th in 4 days, this could easily move back down to, let's say, $44.99. And you're getting assigned at $49 a share, but now the stock is trading $4 below the put that you sold. So that is where the risk is. Now, why do I do this? Because if you like the stock and you're willing to own it and you're willing to collect more premium up front and you're willing to take on that risk, then you're collecting significantly more premium and you can then turn around and sell a covered call against the shares that you are assigned, and you can sell it at your cost basis, meaning that if you get assigned at 49, but the stock falls to 45, you're collecting this premium no matter what. You're then going to turn around and sell a call against it at 49 because that's where you got assigned, and collect premium all the while waiting for this stock to go back up to 49 and have those shares get taken from you, called away. And that's essentially a great way to enter this trade and then exit. Now, I'm not telling you to sell puts at the money. Okay, because again, we always want to give yourself some downside protection. So if it were me and I'm looking at this option chain and I've looked at my technical analysis, I've charted the stock, I've studied the price action, I would probably come in here and I would probably go for this $46 strike. Now, why would I do that? Well, it's a 25 delta, so it is right in between 20 and 30. So again, it's between that 70-80% chance that I'm not going to get assigned those shares, and that I'm going to collect the premium and my cash collateral is going to be released and I can move on to the next trade. And on that strike, I'm still collecting anywhere from 87 cents, $1, 87 cents to $1 in premium per share, which again, on 100 shares, one option contract, $87 to $100. Now, you're thinking to yourself, Tanner, that's not very sexy. That's not very much money. I'm literally fronting $4,600 and I'm only making potentially $100 off it. Well, let's get into that because that's super important, right? That's part of my rule system as well, because we need to have this make sense in a way to where you have the incentive to do this. Okay. So if we come in here and let's say for argument's sake, we can only get 87 cents. Okay. Well, again, that's $87. Let's divide that by 4,600, which is our cash collateral in case we get assigned those shares. That is almost a 2% return. It's a let's round up. It's a 1.9% return. Now, again, most likely on this trade specifically, I can probably get $92 to $94. Okay, putting me almost essentially right at that 2% mark. Now, again, you're thinking, that's not very sexy. Okay, hold that thought. Okay, you're thinking, that's not very sexy. I understand. I thought the same thing when I first learned this. But watch this. Let's say you have $10,000 that you begin investing and you start selling options, and your goal is to make 2% a week. Well, what's 2% a week on 10,000? That, my friends, is $200. Now, $200 a week translates into $800 a month. $800 a month times 12 months in a year is $9,600. You doubled your money in 1 year. You took $10,000, you made 2% a week, that not sexy number we talked about, and you made $10,000, meaning you doubled your initial capital investment. Now, the S&P 500 does what? 8 to 12% a year, essentially, and you more than 4 times that in 1 year using a very conservative system of selling premium and potentially collecting some really awesome stocks along the way, selling calls against it, potentially doubling your money in 1 year. Now, let's get even crazier. Let's jump over here to my handy dandy compound calculator. Now, let's say we take that 10,000, we do 2% a week, we do it for 5 years. You literally took $10,000 and you turned it into almost $2 million. Now, I know that sounds crazy. I know you're probably sitting there thinking like, there's no way I'm going to be able to turn $10,000 into $2 million. I started selling options a year ago. I started with like $2,000. You saw my account. Or if you've seen my other videos, you've seen my account. It's up to almost $70,000 now in 1 year. So you can definitely do this. These are real numbers. This is not wizardry. This is just a compound calculator, interest calculator. You can go do these numbers for yourself on the internet. But I just want to show you the power of what this can actually do. If you take the time to learn it, you get consistent, you have a nice, safe system that gets you 2% a week where you're not taking crazy risks and you're just slowly growing your capital. Okay, so in summary, option prices are influenced by time, IV, and the underlying price. Greeks help you understand risk exposure. Again, those Greeks are delta, theta, vega. IV rank and delta help you pick ideal trades, and you need to know the chain. You need to know the bid, the ask spread, the open interest, the volume, the delta, the premium you're going to collect, the expiration date of the time that you're selling the contract, all those things, okay? So I hope you found value in this. I hope that you're excited to get out and start using this. My recommendation is to always use a paper trading simulation that almost most brokers have it. I know Charles Schwab has it for sure. Do some paper trading, run some of these puts, sell some calls, learn the system, and just kind of watch how it works using real market conditions with fake money, monopoly money, essentially. But please like, share, subscribe, leave me some comments, and I appreciate you taking the time to watch this.